This is Tom Aspray. Together with my partner John Person, we write PA Stock Alerts, a sophisticated stock market report that covers the market in depth 3 times a week through video updates. Both of us have over 30 years experience in the markets, and I thought you might find this excerpt from one of John's recent webcasts quite interesting. If you do find it interesting, feel free to sign up at our website, pastockalerts.com, for the free trial. No obligation. We don't sell our lists, and you'll have access to 3 video updates a week, as well as email updates when necessary. During these critical market times, it could make a big difference. Here's John.
I think one of the things that we like to, or we should do as analysts and traders, and to understand how to choose and use the best non-correlated indicators. It's good to use corroborating information. It's very good to use confirming indicators, but we don't want them correlated. And what that means is if I'm looking at a moving average study, I don't want to be looking at the same type of moving average settings that might be in an indicator like a MACD, a 12, 26, 9 setting. So I want to kind of avoid any type of a moving average or an indicator that are dependent upon each other. That would be just not a non-correlated indicator. I like to use multiple indicators and several tools. The first thing I like to say is, where's the market been? In what condition has the market been in? We're going to show you a pattern tonight that I think is probably one of the most powerful patterns that you should study. And it's not a head and shoulders, and it's not a bull flag, it's not a pennant. It's one of the most powerful patterns that you need to recognize that may help you to identify when a market will begin a potentially strong trending condition and when a market starts to enter in a consolidation phase. So that's one of the things that we're going to go over in just a minute. Another thing is not just to understand where the market's been and what condition it's in, but another question is, who's in the market? Whose hands are the markets in control of? There's a little known report that we all take a look at every Friday, and I'm going to share with you how to look at that you have equal access. It's one of the best sentiment indicators out there, and it shows us exactly who's in the market, and it breaks it down from us from a commercial standpoint to a large speculator to a small speculator standpoint. The report is called the CFTC Commitment of Traders Report. The CFTC Commitment of Traders Report, COT, deals with commodities. But it's interesting that most stock traders don't take a look at this. Even Forex traders don't look at this, and they can. It's something that I've been teaching and writing about for years. In fact, even in my Candlestick and Pivot Point Trading Triggers book, I wrote about that in 2005 and showed people how they can apply this little-known product called, and you're going to love this one, an exchange-traded fund. I mean, 7 years ago, nobody was really interested much in exchange-traded fund except for maybe the spiders and the Qs. But I introduced how stock traders could take advantage of an exchange-traded fund in a foreign currency, namely the FXE. And I shared with them how they could look at directional changes and take a look at measuring the market, taking a temperature of the market by looking at that Commitment of Traders report. And still to this day, it's very valuable information for identifying overvalued and undervalued market conditions. And we're going to show you how this reflects in the S&P contract right now. So I'm not sure how many people are extremely bearish on the market right here, but I'm going to share with you from a Commitment of Traders report. It seems that the vast majority of small speculators that are trading are extremely bearish in the stock market right now as we speak. So that's an important indicator to pay attention to. Number one, where's the market been and who's in the market? Number two is to examine the present condition of the market. What's the health and the breadth of the market? We like to look at the price trend and momentum studies. I know a lot of people struggle with, for example, volume studies, and they see a trend and the market moving up and it's on extremely light volume. And volume has been for a number of years, has not been a very reliable indicator as it has been written about in the past, namely because In the past, when they talked about volume studies, they didn't have as many traders deferring positions in options. For example, I don't have to be long in the S&P futures. I don't have to be long the spiders. I don't have to be long in a stock portfolio position that has a high beta to the S&P 500. I can simply do a synthetic option strategy that puts me in a long position, and it would not show up in the volume studies of looking at the either the cash market or the futures market. So my point is that volume can be masked by the array of derivative products that are now available to us, either by U.S. markets or, more importantly, foreign markets. So we now have a way of masking and spreading off. In fact, people used to be able to buy gold on the COMEX or buy physical gold. Now we can buy gold stocks, gold ETFs, you can buy options, you can buy gold a myriad of ways and take a long position and still mask that volume so it won't show up in the derivative markets. So there's better indicators out there to help us measure some volume, and I'm going to share with you what they are, how I use them, and how they can help you as well. So we're going to talk about the health and some breadth indicators tonight. Real quickly, we're also going to talk about some of my favorite forecasting tools, and I call them looking at the future, looking at what the typical supply and demand and price forecasting tools are, and also price targeting tools. One of the two of the tools that I use is seasonal analysis. Every single year, it's not an exact science, but it's fine-tuned enough to let us know that at certain times of the year there's an increase in demand, and sometimes there's a decrease in supply. And as that situation evolves, it creates price pressures to rise. And when we have times where we see increase in demand and decrease in, when we see an increase in supply and a decrease in demand, we see price tendencies falling. So I think everyone needs to look at what is the typical seasonal analysis. Is there a good time of the year to buy stocks? Is there a bad time of the year to buy stocks? And even in the bad times, do we see periods where we see short-term pops to the upside in the market? And that's what I think most traders fail to recognize. And I think with the age of information, by looking at all the blogs and all the chat rooms and by looking at all the TV, the media, the newspaper, we are so inundated with information that we kind of tend to lose either the confidence in the trading plan that we've already spent time developing because news alerts hits us in the face and we, like Japan, I mean, that was a good one, the nuclear reactor meltdown. You may have been bullish in the market, but boy, by gosh, how many people have the experience of trading in a nuclear reactor meltdown, right? So news events can kind of spook us out of our trades, but on a smaller scale, we have so much information thrown at us, we could change our opinions in a heartbeat. And I think that's one of the things that, not only helps drive the markets, but more importantly, it can help, or actually more importantly, hurt individual investors who aren't maybe set with a specific game plan in mind and hurt their performance and distract them. So I think by looking at supply and demand factors, you can start to develop a game plan months, weeks, days in advance and help to keep you on the right side of the market, or at least if you're not going to trade, to keep you from making a devastated loss by being on the wrong side of the market at the wrong time. And that's some of the things I think is going to be really neat in tonight's presentation. Now, as I promised, this, believe it or not, is probably one of the most important patterns that you're ever going to see, and I'll explain why. Most people fail to recognize that a trend or a market is going to move up until it's too late. And then by the time they get the courage to buy, that's when they start to see the trend exhaust itself. One of the first ways that I look to see a trend, if it's an uptrend, when does an uptrend cease to exist? When the bullish conditions change. That sounds pretty simple, but let's review. A bullish condition not only exists by higher highs and higher lows, but mainly because the market closes above past or prior highs. We have a new closing breakout. We have a new closing high. The market's expanding into new price territory. So when the market ceases to continuously expand and we start to see a reversal of those bullish patterns, remember, the market's not, generally speaking, from an uptrend. We don't see immediate reversals or what we call a V-top. Generally, the market goes through a period of trend and then consolidation, or what we call congestion. Others will call this a distribution top. It takes time for the market sentiment to change. Bulls still want to buy on the breaks, bears still want to sell rallies, and the market goes through that consolidation choppy phase. And this is where most people lose their money. They start to look that they've missed the move, they start to buy when they think the market's going to break out, then the bears come in and say, oh, the market's over, I'm going to sell on the first breakdown, and then the market goes back up and tests the high. One of the things that I like to share and teach and really point out is that when a market goes through a trend, it's never a good idea that when the bullish conditions cease to exist, it's never a good idea to sell the breakdown on the first attempt, because generally speaking, the markets will go back up and test the highs. And I think that's where people get trapped. And no matter what the news is, maybe longer term they're correct in their thinking that they should sell and get short on a low, but over time the market may chop back and forth. So it's best to miss that opportunity and get short in the hole and wait for the market to maybe see if it's going to retest its high. So in fact, the reason I bring this up to you right now is because this is the kind of pattern that we see and developing in the U.S. equity markets right now, but on a longer term scale. And the key is, as we get out of this congestion phase, are we going to resume that trend, or are we going to reverse the whole trend, and the whole trend being the last big upwave that we've had in the marketplace? And so that's where seasonal analysis can help us, and some other price forecasting tools, in addition to looking at whose hands the market's in control of.
This is Tom Aspray from PA Stock Alerts. I hope you found this excerpt from one of John's webcasts beneficial. We will be releasing additional excerpts from his entire webcast that lasted over an hour. And if you'd like to see what we're saying about the market now, we usually take a different tack from most of the market analysts you'll see on CNBC or elsewhere. Please feel free to come to our website, pastockalerts.com, and sign up for a free trial. You'll get 1 month's worth of video and email updates. I think you'll find it beneficial. Thank you.